Welcome to Connecting the Dots. And Fed announced raising interest rates by another 25 basis points. This brings the target interest rate to 4.75 to 5%. I was looking at a historical chart today that sparked something in my mind, and I wanted to share that. So we look at the interest rates, Fed fund rate, all the way from 2009 all the way to today. We had a period between 2009 to 2016 where we had zero interest rates, and from 2016 to 2019 the interest rates were anywhere between 0 and 3%, and then after that we had zero interest rates in 2020, and now we are at 5%. So if you look at this and to put some things into perspective, let's say there were any kind of loans which had floating rates coming due. For example, like commercial loans, I hear 5-year reset where they'll go back to whatever is the current interest rate, 5-year fixed plus current interest rate. So all those loans were taken at an interest rates of less than 3%. So on an average, bulk of the loans were taken for less than 1%. And if any of those loans come for a reset, we're looking at a 5% interest rate today. So contextually think about this way, even the 5%, let's say 5% is a very high number considering the inflation is probably going to come down in the future. Let's assume the steady state rate to be even 2% or 3% from now to the next 3, 4, 5 years. If we believe that, I think a lot of this floating rate debt structure is going to be under deep trouble. That's very visible because you have taken something at 1% and you bought something with that kind of cost structure, and if the interest rate goes from 1% to 2, 1% to 3, there'll be a big effect on the asset values as well as the loan structure and loan requirements for the bank to feel comfortable. So that's something to think about. I was reading another article just to connect the dots. Blackstone was saying that the whole banking crisis could have an equivalent to 1.5% of rate increase from Fed. Think about it. So they're saying almost 1.5% of rate increase kind of an effect coming from the banking crisis. So the banking crisis did some of the Fed's job in slowing the inflation. Potentially we're going to see significant slowdown in inflation by the end of the year, and Fed is projecting a 3.3% inflation by the end of the year. So that's on the Blackstone part. And then the other piece I want to connect back finally to the Fed funds rate is Ray Dalio put an article regarding Silicon Valley Bank, and he's saying that it's canary in the coal mine, so it's just the beginning. One thing he mentioned over there is the negative effect is going to be clearly visible in the commercial real estate, venture, and then he said in some private markets. I couldn't really understand what he meant by private markets. But let's take the example of venture and the commercial loans. Venture had a huge tailwind because of the zero interest rates. A lot of these pension funds, various other endowment funds, they had to look for some source of generating income, and they started going up the risk curve, and a lot of funds, money flew into the venture funds. That's like the story we hear from everyone, right? So, and a lot of the companies in the venture-backed sector are long-dated companies in the sense that they invest a lot of money for growth. They would generate cash year 4, 5, 6, 7. So in a high interest rate environment, because of the discounted cash flow model, they'll be valued much lower compared to like already cash flowing companies. So essentially they have a headwind over there. On the top of that, I mean, if you're hearing some of these venture guys, they see there's a severe reset coming similar to the 2001, 2003 likes. So that's one thing. And there was an example of a Stripe, the darling private company, is doing a down round of almost 50%. So that's the venture part connecting to Ray Dalio's article. And the other one is the commercial loans he mentioned. I was talking to a friend this weekend. He's interested in real estate and he's been talking with some commercial brokers. One thing he brought up is he spoke about an apartment building listed at 2.2 million or something to his broker. And the broker, real estate agent. The agent said he wouldn't buy that property for anything less than 50% of the value. So you see there's a 50% haircut on the venture companies. And here on a smaller scale, this is like a 10-unit apartment. People are talking about a 50% haircut to make it like sort of a fair price for the current market in some sense, right? So I feel like this whole Fed fund rates getting close to 5%, being at zero or 1% from 2016 to 2020, 1 to 2%. If we stay in an interest rate environment about 2%, 3% for the next 3, 4, 5 years, we're going to see a prolonged pain in these two sectors